What's up, guys? It's Tyler here again, and today I'm going to be talking about option gamma. It's one of the option Greeks that you commonly hear, and I'm going to get into the practicality of how to think about it and how to use it in your trading. But before I do that, I know the market's been crashing a lot and people thinking that they're missing out on this massive down move, but don't feel that FOMO. All right, guys, FOMO does not help you, and if you have trouble getting rid of this horrible emotion, check the link in the description. You can see AK has a free FOMO trading guide. All you got to do is enter in your name, email, boom, it goes right out to you for free. Definitely download it. FOMO is an emotion that every single person has, no matter how experienced they are in trading. We constantly have to work to reduce that, because whenever you trade out of FOMO, let me tell you, it ain't going to end well. All right, so let's get into the main content of the video. So first off, I want to look at the dictionary definition of option gamma. And to do that, we're going to go over to Investopedia. And what does Investopedia say? Investopedia says that gamma is the rate of change in an option's delta per 1 point move in the underlying asset's price. Gamma is an important measure of the convexity of derivative's value in relation to the underlying. So basically what it's saying is the gamma is the first derivative of delta and is used when trying to gauge the price move of an option relative to the amount it is in or out of the money. And what they're saying here in the rest of this article is that generally gamma is larger the closer the option is to the money, and it is smaller the more in the money or way out of the money it is. I'm going to show you guys what all that means here in a little bit. But before I dive down into the Thinkorswim platform, I want to bring a practical trader definition to you guys, because we can read into the little mathy and physics definitions, and they don't actually really help you in trading. They just help you in math, or help you if you're working for an investment bank and creating option models for them. But this is how I want you guys to think about it from a trading perspective. So long gamma, whenever you buy an option, you are long gamma no matter what. You can buy any option. As long as you're buying it, you're long gamma. Now, if you are selling that option or shorting that option, you are short gamma. It doesn't matter what expiry, what strike. Whenever you short an option, you are short gamma. And the main difference is that when you are long gamma or long an option, your P&L and your position size grows in your favor as the trade plays out for you. And then when it goes against you, it shrinks. Now, the opposite's true for short gamma. So as a option goes against you, that position gets bigger and your P&L starts to get more and more vicious and grow larger and larger teeth. And so you can see here there's a big issue with this, because especially for short option players, because we all know, good trading principles is to make sure that you cut loss and have good risk management and let your winners run and try to add to your winners and maximize your winners. Well, a long option does that automatically for you because you're long gamma. That gamma is basically a little trade manager in there, making sure that, hey, when something's going against you, it's reducing size, it's reducing exposure. When something's going for you, it's gaining size and gaining exposure. Whereas when you're short an option, the opposite's true. That's actually doing bad trading practice. And as the position's going against you and you're short an option structure, you start to feel exponentially more and more pain. All right, now we're going to take one step further down here with my handy dandy little whiteboard here. And let me draw a graph here. And let's call P&L P plus L over here, and this is the stock price. Now, when you're long an option, long gamma, this is how the payoff profile generally looks. So let's say you're long a call. As the stock price goes up, you can see how the options profits start to exponentially increase, and then as the stock goes against you, it sort of tails off here and you're at some sort of a capped loss. So that's what a long gamma curve looks like. Now, a short gamma curve looks exactly the opposite. So let me draw another graph here. We got P plus L, and we can see, let's just say the zero lines here. And as, say we're short the call, the graph's going to look like this. It's literally the opposite. So if we have the stock price here, as it goes higher and you're short the call, you can see that losses mount at a quicker and quicker rate. So as the stock moves up, you're losing money faster and faster. And then when the stock goes for you, you're actually winning money at a slower and slower rate, and then eventually caps out. So this is what a short option profile looks like. And so the main thing to remember, the easy thing to remember here is long gamma profiles are a smile and short gamma profiles are a frown. And when you're long gamma, that means that something can go any which way for you and you don't have to really worry about it, right? So if it goes up or if it goes down, you're pretty much protected, especially if you have an option spread on both sides. When you're short gamma, you always have to worry about unbounded risk on each side. And so take away these two graphs. It's smile for long gamma, frown for short gamma. And this works really well too, because the smile profiles don't need that much trade management, but the frown profiles need a lot of trade management. Okay, now let's move on to our handy dandy little toss right here. And I want to show you guys exactly how these profiles play out. So let's add a simulated trade. And remember, when you are long gamma, you are buying an option. As long as you buy an option, I can go on here and buy any option on Tesla and I will be long gamma. So boom, let's buy that one. Now let's look at our risk profile. You can easily see here how we have this exponential increase to the upside, and it looks a little bit different to the downside, right? So when it goes in our favor, we exponentially grow our profits. When it goes against us, it slowly cuts our loss and eventually caps our loss out. And so we instantly know that this is a long gamma profile. Now, if I go back to the simulated trade area, let me exit this one out. Go back to simulated trade. Now, if I sell any option on this option chain, any single one at all, you guys will see the exact opposite occurs to where, look at this. So I sold a put in Tesla, and now if Tesla were to go down, my losses mount and get heavy and heavier as they go against me. And so fool around with this simulated trade thing right here, and you're going to be able to look and see, hey, do I have a frowny face or do I have a smiley face in my option structure? So for example, I can go in here and I can make some complex option structure. Maybe I'm buying this one, I'm selling that one, and I'm buying that one. So I just did a complex option spread. Let's look in the risk profile and see what we got here. So it looks like, yeah, we're generally long gamma in this spread because we have cap loss and a limited gain. Let's try another one. Okay, Tesla again. Let's sell that. Let's sell this, and then let's buy a few of these. Let's buy 20 of these and see what that looks like. Okay, so you can see that this is relatively even on both sides, which means our gamma is probably even on this spread. But let's say I take this down a little bit, and you can see as I move this long option down, we start to get more of a frowny face here, which means that we have upside risk, right? So, and we have downside risk. So now that we have uncapped risk on both sides, this position is short gamma, and so we got to keep extra attention to this thing. So in conclusion, guys, option gamma, the only thing that matters, know if you're a long gamma or short gamma. If you're long gamma, you can breathe, you can relax, you can go to the beach, you can chill out because there's only so much you can lose on that position and there's no unbounded loss. You have the smiley face profile, which means you have unlimited gains and limited losses. If you're short gamma though, you better know exactly what you're doing. You're going to have to manage that position. You're going to have to make sure that if something goes far, far against you, you can cut that loss and save your account. So that's the clear thing to remember with option gamma. That's the most thing that matters for trading. Thanks for listening, guys. Now, before you go, again, I want you to quickly check out AK's FOMO guide. It's linked in description. Put in your first name, your email. It's going to teach you how to avoid FOMO trading, which is just so critical these days because people like to jump into hot trends on the upside and the downside. This will stop you from doing that and getting your account torn apart. And finally, if you liked the video, make sure you hit subscribe, hit that little bell. I'll be here soon, guys, and make sure that you hit that bell so you know when I'm going to be here next. Thanks for watching.